Coinbase is trading right now at $286.60. That's up $2.86 on the day, moving up 1.01%. Most people see that ticker, COIN, and their analysis begins and ends with the price of Bitcoin. They think it's just a leveraged bet on the crypto market. The expectation is simple. Bitcoin goes up, coin goes up more. Bitcoin goes down, coin falls off a cliff. But that's not what's happening under the hood. The reality is that today's steady climb is happening while the broader market digests a new reality. Coinbase is aggressively shifting its business. It's moving from being a simple, volatile casino to becoming the essential, regulated financial plumbing for an entire new asset class. The market is slowly realizing this isn't just a broker. It's the toll booth, the vault, and the railroad all in one. Look, we all know the story that got Coin here. During the last bull run, it was the go-to investment for anyone wanting crypto exposure without the hassle of private keys. People using the Robinhood app for their Robinhood stock trading saw crypto as the next big thing, and Coinbase was the safe way to play it. The Robinhood crypto offering was there, but Coinbase was seen as the specialist. The narrative was all about retail transaction fees. It was a simple, high-growth, high-risk story. This attracted a lot of self-investing individuals looking to invest online. But that narrative is now dangerously outdated. If you're still trading Coinbase based only on retail trading volumes, you are missing the company's structural transformation. The expectation is that fee compression from competitors like SoFi, with SoFi Invest, or Interactive Brokers, with its Interactive Brokers trading for crypto, will crush Coin's margins. And for the retail side, that pressure is real. But the reality is that retail transaction fees are no longer the only story. The real story is institutional custody, subscription services, and the emergence of their base network. The company is actively diversifying away from the very thing that made it famous, and the market is just starting to reward it. Let's talk about the last earnings report. The Q3 numbers were a perfect example of this. The expectation was a beat driven by the crypto market's renewed enthusiasm, and we got that. Transaction revenue came in strong at $1 billion. But the reality, the number that made institutions sit up, was the $747 million in subscription and services revenue. This segment blew past guidance. This is the sticky, high-margin, predictable income stream that analysts have been begging for. It includes staking revenues, custody fees, and interest income. This is the part of the business that doesn't care if Bitcoin is up or down 10% on the week. It shows they are building a durable financial model, not just riding a wave. This is the kind of diversification that platform investors, whether they are using the Fidelity trading platform or the SoFi trading platform, look for as a sign of maturity. This leads to the real engine, institutional activity. The approval of spot Bitcoin ETFs was the starting gun. The expectation was that firms like Fidelity, with its massive Fidelity Wealth Management arm, would just build their own custody. The reality is they didn't. They outsourced it. Coinbase became the custodian for 9 of the 11 spot Bitcoin ETFs and 8 of the 9 spot Ethereum ETFs. This is a massive, industry-wide vote of confidence. Every time an advisor using the Schwab Intelligent Portfolios or a manager building Fidelity ETFs allocates 1% to a Bitcoin ETF for a client, Coinbase gets paid. A recent survey confirmed this, showing over 75% of institutional investors plan to increase their crypto allocations in 2025. They aren't doing this on the Robinhood app. They are doing it through Coinbase Prime, and Coinbase Custody is securing the assets. This is the picks and shovels play on an industrial scale. This is the kind of investment help that big league players need. This 286 level we're at today is interesting. The stock has been incredibly volatile this year, trading as low as $151 and as high as $419. This 280-290 zone has been a place of consolidation. We're seeing average volume, not a spike, which suggests this isn't retail panic or euphoria. This is likely larger players absorbing shares. The stock is well above its key moving averages, showing strong momentum, but it's still trading at a high valuation. The P/E ratio is over 31. This isn't a cheap stock. Unlike Apple stock or other tech, which trade on more predictable hardware cycles, or Tesla stock, which trades on EV delivery numbers and AI promises, Coin trades on this mix of crypto sentiment, regulatory news, and this new emerging fundamental story. It's a unique beast among investing sites. The macro environment is a headwind. High interest rates are bad for risk assets, and crypto is the king of risk assets. But the regulatory environment is where the real tension is. For years, the expectation was that the SEC would sue Coinbase out of existence. That lawsuit is still an overhang. But the reality is that the legislative branch is finally moving. The recent discussion draft from the Senate Agriculture Committee, building on a House bill, suggests a path towards clarity, especially for defining what's a commodity, CFTC, versus a security, SEC. In Europe, the MiCA regulations are already providing a clear framework, which Coinbase is embracing. This shift from regulation by enforcement to regulation by legislation is a net positive. It's the biggest risk, but also the biggest potential catalyst. Clear rules would be a massive green light for the Fidelity investments of the world. So, to be clear, Coinbase has multiple business lines. There's the retail brokerage, the app that most people know, which competes with SoFi Active Investing and Robinhood Crypto. This is the old story, the simple online investment platform. Then there's the institutional side, prime brokerage and custody, which is becoming the dominant narrative. But the future story, the one that could justify a valuation even higher than this, is Base. Base is Coinbase's own L2 scaling network built on top of Ethereum. The expectation was that this was a small side project. The reality is it has exploded. As of this month, Base has over $10 billion in total value locked. It's processing a huge volume of stablecoin transactions and on-chain activity. Why does this matter? Because Coinbase, as the primary operator, earns a portion of the transaction fees from this network. They are no longer just a broker on-ramp, they are becoming the ecosystem. They are building the highway, not just the cars. This is a new, potentially massive revenue stream that almost no one was pricing in 18 months ago. They also just launched a new token sale platform, allowing verified U.S. retail to get in on early-stage projects, another new line of business. This is far beyond what a simple Fidelity mobile app or Robinhood cash management account offers. So what's the bull case from $286? The expectation is just Bitcoin to $100,000. The reality is far more durable. First, the full ETF suite. We have Bitcoin and Ether ETFs. The next logical step is a whole suite of products, baskets of tokens, yield-bearing products, etc. Coinbase will be the custodian for most of them. This is a growing, recurring revenue stream. Second, Base monetization. The $10 billion on Base is just the beginning. As more apps and developers build on it, the fee revenue becomes a material part of their earnings, separate from trading. Third, regulatory clarity. If the U.S. passes a clear market structure bill, it removes the single biggest risk from the stock. The moment that happens, institutional capital that has been waiting on the sidelines gets the green light. This is the all-clear signal for every intelligent portfolio manager. But we have to be realistic. This is not a set-it-and-forget-it investment. It's not a utility. The risks are massive. First, the SEC lawsuit. If the courts side with the SEC and declare many major tokens to be securities, Coinbase's entire exchange model is in jeopardy. This is the existential threat. Second, valuation and competition. The stock is expensive. It trades at over 31 times earnings. That bakes in a lot of good news. Meanwhile, competition is real. Interactive Brokers is for serious traders. Robinhood fractional shares and zero-commission crypto appeal to the low-cost crowd. And SoFi is bundling everything. Coinbase's retail fees are still high, and that's not sustainable. They must succeed in their pivot to services. Third, a crypto winter. We can't ignore it. If the macro environment sours and Bitcoin enters another multi-year bear market, all boats will sink. Institutional adoption will slow, trading volumes will dry up, and the base network's growth will stall. The company is more than just Bitcoin, but it is not decoupled from it. Investors using Fidelity IRAs or other long-term accounts need to understand this volatility. This all brings us back to that core institutional story. The company's future depends on this. Comment below. What percentage of your total portfolio do you think will be in crypto-related assets 5 years from now? 0%, 1 to 5%, or over 10%? I'm genuinely curious to see what the sentiment is. So, as we watch Coinbase hold this 286 level,